The idea of buying and holding forever and not trying to make adjustments requires that you've gotten it right in the first place. You can only hold tight if you've bought right.
Most of the advice you get from mainstream financial media tells you to just buy and hold a mix of stocks and bonds. They call it diversification. But as we've explored before, when the market takes a dive, those diversified portfolios can, and frequently do these days, move in lockstep straight down. Professional money managers, those that are running multi-billion-dollar endowments, for example, at places like Yale and Princeton, they know better. They don't just settle for what's on the menu at a big box brokerage. They look at additional investment options, like alternatives. Let's explore what alternatives actually are and the high bar requirements you might need to jump over to get access. Welcome back to the most savvy individual investors out there. For those of you who don't know me, my name is Steven Spicer, and it's my goal to help you overcome the significant risks to which the traditional stock and bond portfolio leaves you exposed. So let's do it. Simply put, an alternative is anything that isn't a stock, a bond, or cash. We're talking about things like private equity, real estate, precious metals, or even niche investments like legal finance or cell phone tower leases. The goal here isn't just to find cool investments. The goal is a lack of correlation. We want assets that don't care what the S&P 500 is doing today. If the stock market is having a bad hair day, we want something in our corner that's still doing its job quietly in the background. Now, you've probably heard the term accredited investor. And this is the SEC's way of arbitrarily drawing a line with the goal of protecting the unsophisticated saver. To be considered an accredited investor, you generally need to meet one of two hurdles. The income hurdle says that you've earned over $200,000 individually or $300,000 with a spouse in each of the last 2 years with a reasonable expectation of doing the same this year. The net worth hurdle says that you have a net worth of over $1 million, excluding the value of your primary residence. It can be a high bar for some. And it's why these opportunities have felt exclusive for so long. But a couple of factors are contributing to these opportunities becoming accessible to more and more investors. One, that bar hasn't changed since it was first set in 1982. That means that with the inflation of everything, including incomes, a larger and larger percentage of the population of people will qualify over time without necessarily becoming any more savvy, which is what they were aiming for. And two, just because you aren't a millionaire yet, just because you don't hit those criteria yet, doesn't mean you're entirely locked out. These days, there's platforms like Fundrise or even certain specialized ETFs that allow you to dip your toes into private real estate or commodities with as little as $10. This video dives into a few of those other options that fit into this category. But a word of buyer beware here. Just because it's labeled alternative doesn't make it a good investment. You still have to look at the fees, how it's actually invested, and whether that particular investment fits into your unique situation. Whether you're accredited or just getting started, the principle remains the same. We're looking here for intelligently enhanced diversification. We aren't just gambling on the latest trend. We're looking for uncorrelated assets, maybe even some that are cash flowing, that provide a chaos hedge for your hard-earned savings. If you want to dive deeper into your investment planning options here, make sure you're subscribed and have that notification bell on. We have a lot of research-backed content coming your way to help you build a smarter portfolio. And if you'd like to see how those endowment funds that I mentioned earlier utilized alternative investments to significantly outperform the stock and bond portfolio by more than 150%, you're going to want to check out this one next. I'll see you there. Take care.